This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant here. Hope you're well. I hope you're smiling. I hope you're not too absorbed like the rest of Australia with the results of the block the other week. It's really started up a lot of questions around the difference in sales prices from one property to other properties. And for those of you who didn't tune into it, one property, which was auctioneered by Tom Panos, and I had a chat with him about it, went for about $5.6 million. And the other properties on the block were lucky to sort of get over 4. So everyone's going, how could it be so different? And the response is, well, that's just really a product of the market right now. You've seen that all over the joint. You know, auction clearance rates are between 50 and 60%. So sometimes properties get passed in. This is the nature of the beast. Some properties, depending on who wants them, go for a lot more than what other ones do. And sometimes there's no science to it. You think it's madness, but this is the way the cookie crumbles. I did a podcast about it with Tom. We broke it down. You can go and tune into it. Wherever you're tuning to this, whatever feed it is, but have some fun with it. I don't know how interested West Australians are with the block, which is normally an East Coast thing. And I'm going to ask my guest today around it amongst many, many other things. You may know this particular gentleman. He's a good friend, regular guest on the Smart Property Investment Show, Damian Collins. You would know him as the Managing Director of Momentum Wealth, and you would know him as the previous past president of the Real Estate Institute of Western Australia, but he does other stuff as well. That's the crux of today's conversation. He's chairman of Westbridge Funds Management. We touched on this last time we got together, and essentially he's providing a pathway for people to invest in property in a different sort of vehicle, and that is through shared sort of assets in a fund. We'll get stuck into it today. Damian Collins, how you going, mate? You well?
I'm going very well, Phil. Yeah, and I did watch the block and was a bit surprised at that, but I'll listen to that podcast for sure.
Yeah, what was your view of it all, with the price differentials between all these assets?
Yeah, it didn't make any sense, but sometimes you get that emotion and competition and auction, and I guess Tom Panos would be pretty chuffed with the result.
Yeah, well, he's a pretty good auctioneer, and to be fair, though, he wouldn't say it, but there's very different styles of the auctioneers on that show, and he's got his particular brand of getting stuff done. But irrespective, mate, while I've got you, because I want to talk about this new vehicle that you have, how's the Perth property market? You gave us pretty good sense for it last time we got together. You said it was on the way up. You've been talking about it for about 3 or 4 years, particularly over the COVID period. We were checking in all the time, and you were saying things will happen. It's not happening yet. Things are certainly happening in Perth now and WA. Yeah,
it is, Phil. The residential market, look, it's interesting. CoreLogic keep coming out and saying it's flatlining or marginally declining, but when you talk to agents on the ground, that's not the feedback that we're getting. Well, no doubt the interest rates have had some impact, but we come from in WA market is very affordable, lowest median house price. And the stock for sale is incredibly low, and sales are solid. So could it plateau and flatline or jump around a bit for the next 6 months while interest rates get sorted out? Quite possibly. But if we get all these migrants that we keep hearing that are going to come into the country and to the state, I think that's on the demand side, that's really going to help fuel recovery. Even on the East Coast, I think the East Coast downturn might be shorter than everyone seems to think, simply because federal government's budgeting on 235,000 people coming in, so they've got to live somewhere, and there's not a whole lot of supply out there. So I think interest rates hurt, but demand side population growth pushes the other way. So I think it's a duel at the moment between what's going to come out on top. Certainly in WA with the affordability, it's better primed to deal with whatever happens in the interest rate market than most other places around the country.
Yeah, I'm trying to rationalise it myself still, and you read of a lot of the commentary around this fixed rate cliff which coming on. I think there's like 3 significant tranche of fixed rates expiring over the next sort of period of time. And my question to people has been, well, interest rates are going up and therefore people's repayments on their mortgages are going up, but they just keep spending. So they've got to keep pushing rates up to a point in time where it hurts people enough so they stop spending, and then we get inflation in check, right? That's a real simple way to view it, but it's the way it works. So people aren't hurting yet. I think when these fixed rates will start coming off, people will start hurting, which will slow things down. So I go, okay, well, am I worried or concerned about the property market as a result of that? But then I hear what you're talking about as in the demand side of things, supply and demand with wrapped up in interest rates, there's still going to be a lot of upwards pressure on property prices for the demand to get it. And in order to buy something, you're going to have to pay a particular price. And if more people want to buy something, the more expensive something becomes, right? Yeah. Breaking it down really simply, how much impact do you think this fixed rate sort of cliff, this fixed rate resetting is going to be for Aussie borrowers?
Oh, look, no doubt it's going to impact some people. They're going to go from paying some people around 2%, so they're going to jump to 5, 5.5, perhaps even 5.75 by the time it comes out of that environment. So, look, no doubt it's going to hurt. During COVID, we saved a lot of money. The savings are at record high, so some people are dipping into their savings. But the rates always have a lag effect, right? So people, firstly, by the time it hits their mortgage repayment, sometimes it's 2 months ahead before you even notice it, by the time you get the increase. Then you start dipping your savings a bit, and then people go, hold on, our bank balance is going down, our mortgage repayments are going up. People take a delayed time to react. So we've only had 6 months really of rate rises. I think it's going to start to bite in the first quarter next year. I don't think the Reserve Bank's going to go as high as the bond market predicts. I think they'll do a couple more. They'll do one probably in December. Obviously, January they will pass on, and I don't think they even meet in January. And then they will come back and maybe do 1 to 2 more, but I think it's got to be starting to bite right now, and if not in the Christmas and the New Year. So I think we're getting much closer to the end of it than the beginning of it. And but yeah, that's the demand. That certainly hurts demand and what people are going to pay. But if we get these migrants, and there's so many jobs around the country, 235,000, where are they going to get housed? Because the construction industry, it's dire in WA, and it's pretty bad around the rest of the country as well. There's just not enough labour to build the housing, and so again, fundamentally, lots of people bidding up, looking for housing, whether it's rental or to buy. Yes, interest rates hurt the other side. So it's that dual, what's going to come out on top. And ultimately, I think population growth will win the battle. And so that's why I think any flatlining or downturn, as we're seeing on the East Coast, might be shorter and recover more quickly than some of the forecasters think.
Well, that's certainly good news for a lot of property investors. And East Coast, I'm quite familiar with. The West Coast, WA, I do own assets in Perth. And I was only looking at the other day, London to Moscow, bear with me, is about 2,800 kilometres, right? Sydney to Perth is like 3,700 kilometres. You're further away than what London is to Moscow. And I think a lot of people forget just how bloody big Australia is and how different the markets are.
Yeah, and there's not much in the middle there, is there? With all due respect to Adelaide, it's not a lot in the middle. Yeah, it's amazing. It's and I grew up in Melbourne, and I think the mentality on the East Coast is the same time zone. People can sort of get their head around Brisbane, Gold Coast, and even in recent years they've been buying down in Tasmania. Certainly the last 6 or 7 years because it was so affordable. Not anymore. Harder to get the heads around on buying on the West Coast. It almost seems like a different country, even though it isn't. But I've got to say right now, Phil, the demand from East Coast is pretty strong. We're certainly finding, we're here locally, Momentum Wealth on the ground. We've got a lot of East Coast clients, and I do know some East Coast buyers agents who are popping over and, buying up some stock on behalf of their clients as well. So certainly, if you're sitting in Sydney, Melbourne, you got some spare capital. You're looking at, well, can I get something for 400, 450 in Perth? Absolutely. You probably can't get much in Sydney and Melbourne for that sort of price bracket. So we are certainly, the East Coast investor demand is pretty good at the moment.
Well, you still you speak very eloquently and informed around the WA real estate market, no doubt. The few years you've had as president of the Real Estate Institute out there, you've hung up your boots now. There's a new bloke in charge. How's he getting on?
He's going well. Yeah, he's from regional WA, and he's doing very well so far. So I'm certainly enjoying my time getting back into both businesses. I've got Momentum Wealth and Westbridge Funds Management. So I've got an extra 10 or 15 hours a week, Phil, which has been good.
You've got time on your hands. You can start building out the property funds. Look, I'm pretty familiar with how these things work, but I'm guessing that a lot of our listeners might not be as exposed to property funds and how they work than I am. You can rest assured that most people tuning in this see property as a great asset class, and most people think you invest in property directly. Most people start off with a residential property until they get to a point in time and say, I want to chase more yields. I'm thinking about retirement. I'll start getting commercial. Commercial, you move into a different world, which is inherently a little bit more riskier, operates differently. And then you got property funds. So lots moving in there. Can you just give us a quick sort of sense for this diversification piece into commercial property and then that sort of extension of that into property funds?
So my philosophy has always been on property, and I started in residential and buying residential properties, is that residential is a great place to start your investment journey, but it's not where you want to end up. If you have $2 million of net residential, for example, with no debt, your yield, if you're trying to retire that, your net yield, depending where you are in the country, is going to be somewhere from 40,000 after all your expenses to maybe 60,000. So that's not a lot of income if you've got to live in retirement, you don't want to work anymore. That's why residential, you can negatively gear. It's a great place to start while you're working. You can build some wealth through that phase. But always, my philosophy is you start in residential, you finish in commercial or development opportunities, because they provide a better return, but they certainly do carry more risk. Now, for residential, most people can buy it individually. They can have a small deposit. They can go get the money from the bank, borrow 80+%. So generally, you can do that directly. But when you get to the asset classes like commercial property, or you want to get into a development, suddenly the amount you need to get in is quite substantially higher to get a decent asset. So if you're buying a decent commercial asset, it's really, you don't get much change for 5 mil, and even under 10 mil, it's hard to get good quality assets. It's also the same in development projects. If you want to do a good quality property development, we're developing to sell, generally talking about 5, 10, 15, 20 mil to get into good quality assets. So Westbridge Funds Management was established, the whole business was established 16 years ago. We had ran part of it under a different brand, part of it under Momentum Wealth. We rebranded it, the fund side, Westbridge. So it's been around for over 16, 17 years. But what it does is, in a nutshell, is let's say we go and buy a $50 million commercial property. We might keep it simple, 25 million from clients. We borrow 25 million from the bank, set it up as a unit trust. So if you come into that fund and you had 250,000 in that fund, you're 1% of that fund. And if you have 125,000, you're 0.5% of that fund. And if you're 50,000, obviously you're 0.2% of that fund. But you get 0.2% of the value of that asset is effectively yours through the trust. You get 0.2% of the income. And investors love it because us as being the asset manager, we do everything. So in a commercial property, we scouring the market. I've got a guy who's come from one of the big funds, Charter Hall. He's scouring the country, and we buy our commercial assets nationally, looking for the best investment opportunities. We buy it, we manage it, we do the distribution. So investors, a lot of our clients in that space are that a little bit older in their wealth and a bit further on in their wealth creation journey. They're generally looking for diversification. They're looking for someone to do the work so they can go and enjoy life, run their business, go to their job, or even in retirement, they're playing golf and they get that income stream. So it's run as a unit trust, so it's proportional. So whatever the capital value grows to, you get the proportion. Same with the income, and people love it. And we're 750 million of assets under management. Last year we bought nearly $180 million of assets, and we've got clients worth anywhere from $500,000 to $100 million who. Even the clients who are worth a lot more, they could potentially go and do it on their own, but they go, well, I'm still concentrated. I don't necessarily know what I'm doing. I'd rather give it to a fund manager who's going to manage that for me. And I get a broader stream of assets to go into, and allows me to diversify and not have to worry about it.
So quite a lot there for us to pull apart, Damian. You're talking about risk. You're talking about asset selection. You're talking about long-term wealth creation. You're talking about time and energy versus returns, which sort of sets us up for a good chat. We'll get stuck in it. We'll just go to a quick break. So with us back in a moment. Welcome back. It's Phil Tarrant, host of the Smart Property Investment Show. I'm with Damian Collins, chairman of Westbridge Funds Management. Why Westbridge? Is that because you're west and it's a bridge to the east or something or other?
Well, that's actually one of the reasons, Phil. So we're West Coast based, but it's a bridge to buying assets all around the country. So we do in our commercial funds, we've got assets in Adelaide, Melbourne, Brisbane, all around the country. But it's also a bridge for investors who want to get out of just being a residential investor into something more substantial, into commercial and development. So that's the other reason for it. It's a bridge from residential investment through to bigger assets, but most people can't necessarily do it on their own.
I was being a bit glib, but sounds like I was right
on the money.
I get it. Okay, that makes sense. So it's a bridge into other asset classes. It's a bridge into diversification, and it's a bridge into expansion of wealth creation out of resi into other assets. So inside of the funds, because no doubt there is, we'll get into it, different assets in different funds. You do residential development and commercial Do you do commercial development or just commercial asset purchase?
We do commercial development, so generally within a fund. So we generally don't develop it from scratch, but what we do is, so we've recently bought one in Welshpool, which is in WA. It was 37 mil. Part of that site was vacant. We will develop another industrial property on that particular one. So that's a value add fund. So effectively we have three ranges of funds. So we have generally the passive commercial yield focused. So investors are there, they're generally looking for a monthly income stream, generally a lower risk, no such thing, of course, there's no risk, but lower risk. Could be a single asset or it could be multiple asset fund, and they get their monthly distributions, 6.5% to 7.5%, depending on the asset pool. Then you go into asset classes that have a bit more risk, and that's generally targeting 12% generally total return. That's a combination of capital growth and also income. So we've got, for example, one at the moment, a total return fund. We're buying underutilized assets or assets that need upgrading or have leases that are expired. So a lot of people are scared off buying that, but we know that we can renew the lease, or we've got the tenants to go into those sort of assets. They're targeting 12%. And then at the higher end of the spectrum, of the risk spectrum, we do residential development. They're generally targeting 18%, but that comes all in one lump sum. Generally, at the end of the project, bank gets paid back, everyone gets paid. And after 2.5 to 3 years, you put in your dollar. Hopefully, you're getting $1.50 to $1.60 back, depending on the time frame on that asset. But that is certainly a lot higher risk. So they're sort of the ranges. And so the assets, and some investors just like the passive, want their monthly distributions, don't want any risk, don't want any hassle. Other clients like the risk. They might be, still running a business, got an income stream. They're happy to put their money away for 2 or 3 years, not getting any return, and get a big lump sum back at the end. So it really comes down to the investor's risk profile as to where they sit on that spectrum in terms of the assets and the type of the asset classes and the type of risk that they're willing to take on.
Yeah, and a lot of people, they hear about sort of property funds and they think it's this mysterious beast. You read about it in the Financial Review. You either hear great stories about them or really bad stories about them, people blowing their dough. It's pretty simple, right? Like, it's at a small scale, to give some sense to our listeners who might not be familiar with it, it'd be like 4 mates sitting at a pub going, we should all invest in property together. We've all got a different amount of money, so we'll share that up depending on how much we put in there, and let's just invest together as a unit rather than separately. It means we could probably buy different stuff, better stuff, higher returning stuff. So all you've done is really given the architecture and the structure around it all for anyone to participate in that sort of thing. Yeah,
that's exactly right. You could be 4 mates sitting around a pub, and you could go into, generally they would be set up as a unit trust as well if you bought an asset. You obviously talk to your account, but that's how they're generally set up. But this is obviously on a bigger scale, and people don't have to find the asset themselves. They don't have to put the deal together. We're regulated by ASIC, so we hold an AFSL, Financial Services License. So that means that, we're certainly, some of our funds, particularly the retail funds, we have to provide disclosure documents, PDSs, information memorandums. So that's exactly right. It's the architecture to allow more investors who don't know each other, rather than a group of mates, to go into something more significant, assets for 10, 20, 30, $50 million. Clearly, 4 mates generally probably couldn't get into that. So it gives those people that. And then the fact that someone else is managing it as well. So 4 mates to get together and do it, someone's got to put it all together, manage it. In this scenario, we as the asset manager do all that work, and the investors get their distributions, their monthly reports. They don't have to be hands-on. They can be very passive in that investment opportunity.
Yeah, and that's part of the de-risking. The more people in the fund, the less risk there is. So go back to the analogy of 4 mates sitting together. One of them gets divorced, they've got to sell out, and then it turns into a huge issue. How do you trade in and out of property funds with you guys? Is that relatively easy to do? Or if it's, the more development stuff, you've got to put your money away for a period of time?
The funds are all for fixed terms, so you've got to be willing to go into a fund for the term of that fund. So generally the commercial funds are 7 years, and at the end of that 7 years, then investors have a vote whether they want to continue on in that fund or whether or not they want to end that fund and sell the asset. The development ones are typically 2.5 to 3 year terms, but that can blow out. Like if at the moment construction is taking longer during COVID, so the things are taking a little bit longer to finish off. But having said that, because prices went up, the returns have been pretty good too. So you've got to be willing to see it out for that term. If investors have wanted to get out, there can be potentially other buyers in those funds who might want to buy those particular units, but generally, and that has happened, but generally you've got to be willing to go for that length of term. So it's not something, and some of these funds, like property funds do trade on the stock exchange, but they are far more volatile. So you can get out more easily on a stock exchange, but they tend to act like shares. And they can go up 20, 30%, and they can go down.
Driven stuff.
Yeah. And like at the moment, some of them are down a long way. So it's a different beast. It's unlisted. So it's generally the value of it is an underlying asset, not what's happening in sentiment in the stock market. So, but they are illiquid. And that's one of the things that if you go into one of these funds, you've got to be willing to say, well, the term of the fund is 7 years. I've got to be willing to lock my money away for that period of time.
And if I'm driving around town and looking at office buildings, or I'm driving through industrial parks or sort of big developments going on, would most of them be owned by some sort of property fund? Because not a lot of people who can play at that level individually, right?
Oh, absolutely. Yeah. They're generally like you've got a very, very small minority of people around the country who might have that wherewithal and the wealth of, hundreds of millions or billions to go and do that on their own. But the vast majority of those assets are owned by property funds of varying degrees, or superannuation funds. So one way or the other, they're pooled investments, and absolutely. So there could be people who own that office building in North Sydney. Phil, that could be people who own that for as little as $50,000, depending on the asset and the fund. But yeah, they're generally owned, the pooling of money, because it's also the concentration risk. That's the other thing. Even we've got clients who are worth 100+ mil, and for them, while they could go and buy a $10 or $15 million asset on their own, or even a $20 million asset, they go, wow, I've got to manage it. I've got to select it how I know it's right. But also, that's a lot of my wealth in one particular asset. So they often, they might have a $100 million portfolio of wealth. They might say, well, I'm going to have 30 million in property. I'm going to have 60, 70 million in other asset classes, but I'm going to have 30 million in property, and I might choose to split that up 20 lots of 1.5 mil. Some of them do that, and they go, you know what, spreading my risk around and not putting all my eggs in one basket, and someone else professionally managing it. Same with even clients with 2 mil. We've got clients or even 1 mil. They spread around. They might have 10 lots of 50 or 10 lots of 100 for their share of what they want in property, and that way it's spread around and managed by a professional manager. And I think that there is something to diversification. Like resi, again, is great, but we all know it's generally fairly illiquid because you can't sell it tomorrow. You can sell it in the market, but it's also very concentrated. And I think certainly a lot of people now understanding diversification, particularly when it gets to these bigger asset classes, even if you can do it yourself, is that the right thing to do in terms of risk management and diversification? Probably not. You're probably better off to go into a pooled asset, whether it's a group of mates around a pub or whether it's into a professionally managed fund.
So talk to me around, we're talking about diversification in asset classes, different sort of asset classes, getting out of resi into other stuff. How does the lending work in pooled assets? Because in direct investments, you take on the debt, you're reliable for the debt. How does it work if you're leveraging sort of 50% inside of a property fund? Where does that liability sit, and what's your sort of connectivity with it as the investor of or in that unit trust? They're
all non-recourse to the investors. So all the debt is within the fund. So for example, in a commercial fund, we borrow 50, sometimes 55%. That is all done as non-recourse to the investors. So the bank can only, or the lender can only have recourse to the asset that we buy. They can't come back and tap investors on the shoulder. So the investors are protected from the debt in that regard. And same with our development funds, it's still non-recourse. Sometimes I have to put my head in the noose and personally guarantee it as the fund manager, but I'm okay with that because, I'm managing that as the fund and comfortable that we're going to manage those risks. But generally to the investor, there is no recourse on the debt. They're not required to sign any debt guarantee documents or anything. The fund manager manages all that on their behalf. So the investor buys a unit in the fund, and obviously their total return depends on how that asset performs within the fund, but there's no recourse from any of the debt.
And I guess it gives you exposure to new opportunities and diversified opportunities. And because it's non-recourse and you're not connected with the debt inside of the fund, irrespective of how big a chunk of the asset or the fund that you own, it wouldn't be impacting your serviceability then as an individual property investor.
Not at all. So it's not included in your serviceability because the debt was within the fund. So if you put in 100,000, that's just, and you'll get an income stream, which would certainly potentially help support, if it's a commercial passive fund, potentially support your borrowing capacity outside that. But yeah, no, it doesn't affect your serviceability at all.
Yeah. So when do you know as a resi investor it's time to move into commercial, and when do you know as a resi investor move into the commercial to go into a pooled asset rather than a direct asset?
Well, I look at it this way. Everyone's got to have set their own goals, whether they're with their strategy person or whether they're doing it themselves. And to get a decent income in retirement, because ultimately that's what we're all working towards, right? We're whether running our business or we're working in a job, we're investing for the future to build wealth. And obviously, generally, that means we're going to be able to one day hang up the tools or sell the business, and we're going to live on an income stream from those assets and wealth that we've created. So I think my philosophy on this is residential and commercial of your property pool of assets. You might have other investments and shares and whatnot, but generally 50-50. You want to get to a pool of assets that your net wealth is 50% in resi and 50% commercial. Now, they've both got pros and cons. So residential historically has been lower risk. Generally, you don't have too much of a tenancy risk in residential, and that if it goes vacant, okay, in a bad market, you might have to drop your rents a bit. Generally, you'll still get a tenant in. And so, but of course, we know that the rental returns from residential, putting aside debt, if you had no debt, the rental returns are generally going to net, depends where you are in the country, anywhere from 2% in Sydney and Melbourne, if you're lucky at the moment, through to maybe 3.5 to 4-ish potentially in some of the other capital cities like Perth, for example, and maybe Darwin. So let's say you're targeting 2 million of net wealth without any debt. 1 million in residential, that might be 2 investment properties, debt-free and clear. You might net, on that mill, you might net sort of 20 to 40,000. If you had also then another $1 million in commercial property or commercial property funds, that might net you 5.5 to 7, depending on the asset and the manager. That's generally going to have a blended return, total return of 4.5-ish% net. Might get up to 5, and that's then suddenly getting to an income stream of maybe 190 to 120, depending on the. That's not bad. It's starting to get up there, and you're not having to dip into your capital during that term. But one thing to understand, of course, commercial, why does it pay high yields? Does have that high risk exposure. So if you don't know what you're doing and you get a poor quality asset, I've seen commercial properties sit there for years and years and years and years, and you can't give it away. So that's why it's so critical. Our portfolio right now is 100% occupancy across. We don't have any vacancy across in the commercial space. Over $500 million of assets, we're sitting 100% occupied. But that's hard work. You've got to work the assets. You've got to work with the agents to get the right tenants in, the right tenant mix. So that's one of the good things about diversification. If you own the asset on your own, and generally in the smaller end of the market, you're only going to get sort of strata office at best. You're not going to get anything good, really good quality. You could sit vacant on that for 2 or 3 years. If you're in a fund, generally, and you maybe got your money in multiple funds, chances of them all being vacant are pretty slim. So that's another reason for the diversification benefits of going to a fund.
Well, the idea is that the fund manager is good at what they're doing, so they organise it appropriately, so it's generating income. Well, what's, you spoke about those sort of 3 styles of investment, just sort of set and forget type stuff, good assets, good yield, get your money on the way through, something which is a bit of a value add type thing, and then the development side of things, which is different levels and layers of risk. What's the chance of blowing your dough doing this, Damian? Like, how wrong do you guys have to get it that investors like me lose all their coin?
Well, Phil, look, everything carries risk. So we're not in a risk-free world. And if you want risk-free, you might go and buy a government bond. It's about the closest thing you're ever going to get to risk-free. But of course, the returns, obviously they've gone up a bit now. The returns are pretty low. So look, like anything, it's the higher the potential return, the higher the risk is likely to be. So generally on your passive, well-leased properties to good tenants, is there risk? Yeah, things can go down in value. Tenants can leave. But if you've got multiple assets in a fund, or you've spread your risk of, going to multiple funds, it's lower risk. But you're going to get lower returns. You're going to get your 6 or 7% return, net return. You're going to hopefully get capital growth over time, but there's of course no guarantees like any asset class. So your total return there you might be hoping to get, 8, 9% total return, which is still pretty decent. Again, no guarantees, but lower risk. When you go into the value add funds, you're targeting generally that 12%. There is more risk. It's a strategic investment in that you're going to refurbish the property and try and release it at a higher rate, or you're going to take on the tenancy risk. The tenant's moving out, but you're comfortable as the asset manager that you've got a good quality tenant, you can put back in there, and that'll restore the value and increase the value. So there is more risk there, and development is the most risk of all. That's why we see some people in residential property development are billionaires, and some people go kaput. Because it certainly carries a lot more risk. So my philosophy, and this is to our investors, is could you lose money in particular development? Absolutely. Could you double your money? Absolutely. So you've got to be able to sleep at night. I don't want to see anyone go into a fund where they're going to toss and turn about what's happening in a fund, because we can't control everything. A great asset manager or fund manager will mitigate everything they possibly can, but no one here can sit here today and say, by the time I finish that project in 2.5 years, the market's going to be perfectly X. We think it'll be X or Y, but there's no guarantees. So I would say my philosophy on that one is, if you want to put some money in development, don't just put it in one fund. Right? If you've got a pool of money, so I want to take that high risk, put it into multiple funds. So generally then hopefully if one fund goes particularly a bit pear-shaped, then you've got enough spread around. But like anything with a fund or any investment you make, you've got to be able to sleep at night. So never, ever go into a fund more than that's going to make you toss and turn, because yes, there is the higher the return, like anything in life. We see it out there. People get excited by the returns. You've got to understand that higher return is coming because it's a higher risk. And you've got to be prepared that you could potentially lose money. Does it happen often? Generally not, but anything is possible, and you've got to be willing to accept that as part of chasing that higher return.
So for your value adds fund, development funds, are they single assets inside a single fund? You're not sort of pooling a whole bunch of stuff inside of the one fund?
Well, that'll depend. And the good thing about a fund is you'll get, if you're going to invest in one, you'll get either a product disclosure statement or information memorandum, which can be between 20 and 100 pages, as we're required to do under our financial service license, give investors all that information. So you'll know up front whether that's going to be a single asset fund or whether we're going to add more assets to that fund and the type of assets that we're particularly chasing. So right now we do have one fund that's a total return fund. We're putting in, just bought our third asset. That was always the plan. 3 assets in that particular fund we were going to buy within 6 months. Generally, the commercial funds can either be standalone. That's the only asset we're going to buy. And some of our clients love that. Some of our clients like, I know the asset you're buying, so I just want to go in that one because, they like property and they think they know that what's a good asset and what's not, and so they like that. Others are happy to put all in the hands of the asset manager, knowing that we'll build a pool of assets in those particular funds. But the good news is that every fund, you'll know going up front because there's a full disclosure document as to what the strategy for that particular fund is.
Yeah. And on the pooled assets, so really it's a pool within a pool. So you diversify because there's many people into it, and you're diversified even further because there's many different assets inside of the fund. Yep. What sort of commercial assets are you buying inside of it? Your industrial, your sort of specialist stuff like childcares or petrol stations or retail? Is it office? Give us a sense for that.
Yeah. So look, we have an investment committee, and we sit down every quarter, analyse the entire market as to where the opportunities are, where we think we should be investing our clients' money. And then from there, we will then target the type of assets that we're buying. So we are close to 60% of our assets are industrial. We made that decision about 7 or 8 years ago that was a class of asset we thought was likely to outperform. And fortunately for us and our investors, that has been the top performing asset class by a long way over that last 7 or 8 years. We also decided we were very cautious on retail, and we only chose neighbourhood centres and large format retail. So neighbourhood centres generally where you got anchored by a Coles or Woolies or Aldi or an IGA, and you got some specialties around it. So we liked those and have invested in quite a few of those because they were low cost. So our big concern over the last 7, 8 years ago when we really sat down and did some more modelling was what the impact of online shopping would be. And in the bigger, just to give an example, in the bigger shopping malls, the ones we'd all know where they're indoor and they've got very expensive to run, the tenants, some of those tenants are there are paying 18% of their turnover on rent. Now, we just knew that was not sustainable. The neighbourhood centres, your Coles, your Woolies, and they're generally paying about 3 to 4% of their turnover, sometimes 5%, depending on how well the asset's going, of their of their turnover on rent. That's sustainable. So, and same with the large format retailers, your JB Hi-Fi's, the furniture stores. We always looked at that and said, well, we're comfortable. We know that shipping out of a warehouse in South Sydney out to Penrith is very expensive, and that's probably not going to fly, is all the distribution. We knew that the large format retailers would still want to keep their shop front again because it's low cost. They don't have indoor mall. They've got parking at grade outside, so they're much lower cost of their turnover to run. So that's what we invest a lot in. We've invested a lot of retail, that type of retail. We've invested a lot in industrial, and fortunately that has paid off, and our clients have done very, very well out of those particular assets. We've been a bit gun shy on office for a long time, even before COVID, but certainly COVID has made us a bit more gun shy. Our modelling predicts that we think overall tenants will be able to drop about 10% of their space overall as the new norm. Part-time work from home. You still need an office. The office is not dead. So we've got less than 5% in our asset pool in office. There will be an opportunity for that. We're certainly monitoring that space. We still think, depending on the markets around the country, there's a bit more pain, but there will be a time where office will be coming good again once that excess space gets shared, once the market picks up again and takes up. So we're cautiously looking at office. We're not there yet. We're trying to buy well below replacement. There's not enough hurt. We think the rate rises at the moment will hurt some of those office owners who've been sitting half vacant. They've been able to be okay because they've been paying effectively 2% interest on some of those assets. And now they're paying 5%. It's going to start to bite. So yeah, it's really totally about asset selection, top down. What's the best asset classes, the best locations around the country? And then that's the strategy. And then we've set up funds to take advantage of those strategies. So within a market right now, industrial's booming, absolutely going through the roof. There's massive shortage. Australia has the lowest industrial vacancy rate in the world, and particularly in Perth and Brisbane, amongst the lowest internationally within you look at individual cities. So rents are going very strongly. So that's been a great spot to be in. There will be a time when that won't be a great place to be in when it gets oversupplied. So just so critical that you're not just buying anything in commercial. You've got to buy the right class of asset, and then within that, knowing what's the right shed. So industrial, some sheds are past their use-by date if they don't have the right truss height, so they don't have the right turnaround, particularly for distribution. They'll have to get demolished at some stage. So there's a lot goes into asset selection and asset class, but also the actual individual property. The due diligence you got to do is quite significant. Sometimes we spend $100,000 on due diligence on just one single asset when we're buying it.
And it seems like sort of logic in residential, right? You might work out which area to be investing in, then you got to work out what you want to be buying in that area, houses or units or whatever it is, and then which street you should be buying on and what you should be buying on a particular street. The same logic holds true. But I would say, Damian, if you guys sat around 3 or 4 years ago as an investment committee saying, what's the world going to look like, and therefore how should we shape our decision-making in investments, knowing that COVID was on the way, you probably would have chosen the same strategy. Yeah, look, COVID... Luck or chance, who knows, but or you're just bright people.
No, we didn't predict COVID, Phil. I wish we had that much foresight. I don't think anyone had that much foresight. But all it did was accelerate the trend that was already happening: the online shopping, the distribution, the inability of the big retail centres to effectively bleed tenants that much turnover. Tenants are going to go to larger format, much lower cost distribution models. Yeah, all that COVID did was speed up that process that we already saw coming, and that's what we're seeing.
That's what it is anyway. Just want to talk about timing, Damian. We'll just go to another break. Stay with us, everyone. We'll be back in a sec. Welcome back. Phil Tarrant from Smart Property Investment with Damian Collins from Westbridge Funds Management. Now, Damian, we're talking about timing of COVID and how it sort of lent itself positively to the investment decisions you've been making inside of your funds and different types of funds, whether it's sort of set and forget type stuff, established assets or more development. On the development side, timing is absolutely key. Now, you spoke about beforehand, it's really expensive to build at the moment. It's hard to get materials. There's a whole bunch of reasons why. Finding staff to do the building is tough. Development costs are up. Market's coming down or sideways, depending where you are. Getting development right, whether you get a 100% return or a 50% return or a 1% return, a lot of it comes down to how well you can time the market. Is development good at the moment? Are you guys investing heavily in that? Or are you looking at other sort of more stable, less riskier asset decision making at the moment?
So the development, absolutely. Yeah, development, you could make 100%. You could make, sometimes if you get your money back, you're happy with that. And and that's why you're building into an uncertain market. Who would have thought that when you started doing a development in 2019, you started building, no one would have known COVID was coming. No one would have thought in Melbourne they were going to lose 120,000 students. Now, the interest rates and the money that was spent in the economy buffeted that downturn, and now it came back. And of course, now because of interest rates going up, it's going back the other way. So you're dealing in so much uncertainty. And look, development we're very cautious on. So we're around the country, the commercial market. And when we look at construction, really there's two streams to residential construction. There's the commercial market, where generally the trade pool, when you're talking about building multi-story apartments, talking 5, 6, 8, 10 stories, a different set of trade skills generally in those than you'd find in the housing market. So right now around the country with infrastructure, mining, everything going on, that particular commercial building sector is just full. They're absolutely full. Prices have gone up, in WA up 50%, same in some of the other capital cities around the country. So we're very gun shy and cautious on the apartment market, but you also got to look at fundamentally underlying what is still the demand supply outlook. And as we spoke earlier on the podcast, there is real potentially, there's a housing shortage at the moment. And if we get all these migrants, the government's saying we're going to get 235,000 migrants a year net for the next 3 years. That's 720 odd thousand people we've got or 705,000 people we've got to find a home for. So there's still going to be demand for housing. So we've certainly in the last 12 months seen what was happening with construction markets, seeing there's still fundamentally good underlying demand. And the other thing too, we saw the home building market a different story. That is a different skill set of trades. They generally don't gravitate to the commercial market. So the home building market had that massive boom. We all know about all those grants that were given. But if you look at the approvals, they've come right off a cliff. And so we see that's the opportunity where you can build townhouse product and where it's generally that same pool of trades. And so we've done a lot of townhouse stuff at the moment and very comfortable in that space because we know that there's fundamentally a shortage of housing. We know that the building prices will be certainly more manageable because the pipeline that is going through, there's not much coming at the back end. So, yeah, it's about pivoting to the right sector of the market. And certainly we feel townhouses is where we want to be, certainly in the next 12, 18 months. If they stop spending in infrastructure and mining, that might help and help the commercial market. Or we might see a big influx of labour that might help. But right now, commercial building is really challenging. It's taking a long time and costs have gone through the roof. So you probably want to keep away from that space at the moment.
So with townhouses, are you finding it hard to find good quality blocks to build townhouses on? And how's the sort of planning environment and DAs and stuff? Each government's different and some make it very hard, some make it very easy. Is it starting to soften a little bit in terms of development application? I know a lot of the state premiers are sort of talking about removing a lot of red tape happening here in New South Wales, removing a lot of red tape to actually facilitate development.
Yeah, it's always, and I saw in the federal budget, they talked about, this National Housing Summit and, the federal government's keen to get more infill. State governments say, yeah, we want more infill. We don't want to keep building this infrastructure on the outskirts. But then when it gets to local level, of course, the local council goes, not in my backyard, go find somewhere else to do it. So that's always the challenge with development. And that's it. So one of the things you got multiple levels of and multiple stages of risk in development. What I do like it, though, is you can mitigate all the way through. So your first stage when you buy it is due diligence risk. You buy it, but you make sure you do your feasibilities. Then you've got development approval risk, and that can be challenging depending on the local councils and the planning framework in your capital city, wherever you are. But then, sometimes you get to development approval and you stop there. You go, I can't build it. The sales market has dropped. So we can't sell them, or the building costs have gone up too much. We won't move to the next phase. So the good thing about development, you can mitigate the way through. You're not betting all your eggs on that, putting all your chips on that process. You've got multiple stages through that journey where you can sort of put it on hold if you have to. Now, it's not ideal. You don't want to put it on hold. But certainly, development approval risk is still there. State governments talk a big game. They do better to varying degrees around the country. But I always say, Phil, if you go and ask 100 people, what do you think about urban sprawl? 90% will go, that's terrible, it's bad for the environment. Then you say, what do you think about development in your neighbourhood? And the same flip. 90% will say, well, not in my area, it's special. Go do it somewhere else. So that's the challenge in human nature. I think as a country, that's something we're going to have a real look at is we want affordable housing. Well, how affordable is Sydney when its median's 1.6 mil for a house? How affordable is Melbourne? Even Perth, 530,000. It's not cheap. It's certainly a lot more affordable than other capital cities. If we want affordable housing as a country, it's a tough conversation we've got to have, and we need politicians with intestinal fortitude to. The Reserve Bank, we're just getting off topic there a bit. Reserve Bank study recently came out and said 30% of the cost of a house is due to planning and bottlenecks and planning. Effectively, why we're 30% of the cost we're paying for a house is because we don't have enough infill. So. Conversation we need to have as a country.
Well, you saw in the most recent budget, the first budget, this mini budget before the May budget, talking about 1 million houses they're going to get. Yeah,
what was interesting that we're already building nearly 1 million anyway, so I'm not sure how much extra they're going to provide under this big grand policy they've got.
Right, it's a politics podcast around property investment. Who, Damian, and talking about this about property investment, so we're talking about investing in a pooled asset rather than doing it direct. Who is suited to do this stuff? Is it open to any Aussie who wants to get exposure to property?
under the financial services laws that are out there. So our license allows us to what they call a retail product, which is open to anybody, and also to wholesale products, which is limited to sophisticated investors. So generally what we do is the diversified commercial funds, they're generally run and available to anybody. So we have a retail license, we do a product disclosure statement. And so that's available. Who is it suited to? I guess that, look, in this space, it's generally you've got to come and make your own decisions. Some people come through financial planners, but the 90+% of the clients who come into this space make their own decisions. And I think it's about that stage of your life where you say, and that could be for you at 30, at 35, could be for you at 40, could be for you at 60. It just depends on where you're at in your journey. But you've got to be thinking the long term ahead. So if I want to keep all my assets and not have to sell them down in retirement, I want to build that pool of assets. Well, then I need to think about what's important to me. And is it going to be some income stream? Is it going to be a mix? Some people of our clients have got direct residential, they've got then their commercial funds, and they've got a bit in development to top up. They're targeting that 18% return. They might have 10% of their money in that particular fund. So it's certainly funds and investment in funds is not where you start, but it's where you start to look when you finish. So generally it's going to be someone who's got a bit of wealth behind them and has the available capital to go into these types of funds, or they might have their own self-managed super fund. That's where their wealth is. And they're looking for diversification and someone to manage that asset for them. They want to be hands-off. They don't want to sit there and micromanage it. Some of our clients, in our momentum wealth side, like to do still their own developments, and they do their 2 to 4 and they hold those. And some of them don't want to do a passive fund because they go, oh, no, I want to do everything. And other clients go, I don't want to do anything. I want you to do it all for me. So you've got to have the mindset. You've got to have a bit of wealth behind you. You don't have to be rich, but have a bit of wealth behind you. You've got to be willing to have that be a hands-off investment for you, that someone else is managing that for you and reporting back to you. And it's got to be part of your overall property strategy. So depending on your circumstances, where you're at in your journey, that could be earlier, that could be later, but you've got to have a plan, right? That's the starting point for any property investment. What's my plan? What are my objectives? And that will then determine whether or not you should be still in residential, you should be looking at these opportunities. And everyone needs a plan and a strategy. Otherwise, you're just shooting in the dark, and it might not be the right investment for you.
Nice. And I know you're a big fan of property. You love property, but no doubt you just don't do this because you love it. You got to get earn out of it in some way. How do you guys get paid for managing these funds? How does that work?
Yeah, so we get paid effectively a buyer's agent fee. So, and these are all disclosed in the documents that go out to investors as part of the regulatory regime. Every fee gets disclosed to investors. So generally, it's really not that different to buying a property direct, in that if you used a buyer's agent, for example. So we get paid an acquisition fee, a buyer's agency fee, effectively when we buy an asset.
So you find the asset, and you're paid to find the asset on the basis of the strategy of the fund.
Correct. So Let's say it's a diversified property fund, one of the ones we've got at the moment, diversified number 4. We will be paid, the fund is the strategy set out, and that particular fund that we've got, we're buying upwards of $150 million of assets across 8 to 12 assets across the country, all generally passive, long lease terms, good quality tenants. So we'll get paid a buyer's agency fee up front. We'll also get paid a asset management fee. So that's basically to manage all the money, do all the lease renewals, making sure that everything's occupied. If we have to do some refurbishment works during that journey, that we do all that. And we get paid an asset management fee. And then generally based on the performance of the fund at the back end, we would potentially get a performance fee as well if it exceeds a hurdle rate of return. Generally, that's 20% over a certain hurdle rate of return. Depending on the fund, that'll be, and the structure, that'll be between 8% hurdle rate and potentially 15% hurdle rate before we get paid any performance fees. So pretty standard. The funds across the industry, pretty standard in terms of what they charge. But the good thing is it's all in the disclosure document that you would get. And I always encourage people to read those, not just read the executive summary. Read a fund, you make sure you know what you're going into in terms of how long the fund is, what is the asset manager getting paid, because everyone's got to get paid, and make sure you're comfortable with those fees and the terms of the funds that you're going into.
Yeah, and then on that basis, you got a job to make sure you choose the right asset for the fund, but that's going to wash through in terms of how well you manage the fund, how well you manage the assets on the way through, i.e., are they always tenanted? Are the tenants paying on time? All that sort of stuff. You're incentivized for that to happen because at the back end of it, you get incentivized around it. So you got a lot of skin in the game in making sure you get the right outcome for investors in the fund.
100%, Phil. I mean, ultimately, we live and die by our reputation. A lot of our business comes in from referrals from clients who are happy. In fact, our average clients invested over 4 times with us. So they're in more than 4 funds, our average investors. So when people generally come into us, they'll trial us out for one, and then generally after a while, they're very comfortable with what we do and they top up. And as I say, our average investor has over 4 investments. But yeah, reputation's everything. We're out there to buy the best assets and do the best for our clients, and 100%. So does that mean some funds will significantly outperform and some will underperform? Yeah, there's that risk because we can't mitigate every single risk, but that's the beauty of diversification. If you spread your investments across multiple funds, the chances of them all going pear-shaped, not impossible, but is a lot more limited. And but yeah, the only reason a fund manager is successful is based on their ability to deliver for investors, because so much of it is word of mouth and repeat and referral business.
Yeah. So just to quickly summarise, gives you different exposure to different asset classes. Tick. Helps spread your risk. Tick. Gives you diversification into pooled assets rather than direct asset. Tick. It's not going to compromise your ability to borrow more money because you're not up for the debt if it's leveraged in it. Tick. There's a lot of reasons that help you down your pathway transitioning to your earlier point from resi for sort of immediate equity creation through to commercial as a provider for income in retirement. Tick. There's a lot there. Damian, what do people, if people go, all right, I like the sound of that, how do they sort of find you guys? Are you happy to just chat with people if they want to?
Yeah, absolutely. So you can, if you Google us or westbridgefunds.com.au, you'll find us there, and you're certainly welcome to. We've got some good videos too to explain this. I'm happy to. They'll be on our website as well. But also, if you want to chat to myself or the team, go to westbridgefunds.com.au. You'll see some numbers there, and happy to chat and explain it through in more detail. And can also send out previous funds. We've done the PDS or the documents, disclosure documents, so you can see in the past if a future fund comes up. Sometimes you've got to be quick with these, because depending on the fund, sometimes we send it out, and because we've got such a loyal client base, you can't sit on it for 4 weeks. And if we make a call, sometimes you've got to make a relatively quick decision depending on the fund. But certainly, we're happy to provide lots of information, and myself or the team happy to chat through to investors what's involved. And then if you get on our email list, so you say, I'm interested in one of these funds, then basically we'll put you on a email list so that, depending on your interest too, so that we don't just, some say I'm just interested in the residential development funds, or I'm just interested in commercial. You tell us what you're interested in, and then that way also we can, once you sign up through the website, then we can send you out relevant products. If you're interested in that, you want to invest, great. If you don't, that's fine too. And we're happy to provide you with that information and have a chat to clients about what's involved in each particular fund.
And for those of you considering this, you need to remember that if you choose to put your money into one of these funds, that means you've assigned a particular chunk of cash away for a little while, which you can't use for other purposes, which might be buying direct property. So this all comes back to where you are in your investment journey, where you're going, what your goals are, how you want to sort of build your portfolio. It might not be right for a lot of people, might be spot on for a lot of people, but you need to remember you are assigning cash to this, and it's locked away for a period of time. Can't get it out. It's difficult. What's the minimum, Damian? Final question. Like, really to actually to make the juice worth the squeeze for a property investor? I know a lot of people might want to sort of try it out and see if it works, but give us a sense of that.
Yeah, so depending on the fund, it'll be between 50 and 100,000. So it's not sheep stations, but it's not also 5,000.
To that number, then, like that would be you buying one direct asset in Perth at the moment. You would probably need 100 grand to actually get that right now. So.
Yeah, so 100 grand into a fund. So, for example, the diversified fund that we've got at the moment, we've just bought our fourth and fifth assets. That's $50,000. So that'll be $150 million fund. So you'll be that proportionate share of that particular fund. So yeah, depends on the funds. Generally, each fund will be different, but generally 50 to 100,000 is the minimum. So again, it's not cheap stations, but it's also not $5 grand either.
Yeah.
But it's enough to make it worth your while, 50 grand, and hopefully you'll get good returns on the way through.
Yeah, and there's no issue if you just got a self-managed super fund and you got some cash in that, you can plug it in. There's no difference. Is it hard to do it in your super?
Oh, not at all. No, if you don't have a self-managed super fund, it's very, very challenging because the big super funds don't generally go into this space. We've got lots and lots of clients with their self-managed super fund. So that's probably more than 50% of our investment comes from our clients' self-managed super funds.
Cool. All right. Well, Damian, thanks for your time today, mate. I've learned a lot, reinforced a lot to me around this sort of stuff. And it's good to see that you're providing other opportunities and expanding the mindset for property investors. It's good to see you, mate. We'll catch up again soon.
Thanks, Phil.
All right, so that's Damian Collins, chairman of Westbridge Funds Management. You go and find these guys, just westbridgefunds.com.au to learn more. My suggestion, just pick through some PDSs, get informed and educated around this stuff, and ask a lot of those questions that I was asking. They're all fine questions, and any fund manager or any property fund manager should be able to answer them for you. I hope you enjoyed that. Remember, smartpropertyinvestment.com.au, Smart Property HQ on social media is where you find it as well. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.